But I do want to just point out that as we look at the lows of the session here, it's important to continue to look at Treasury yields, and we do have it at 3.20 for the 10-year yield, now 3.21, ticking back up. Is Bob Dahl good? Bob, can you hear me?
I can. Hi, Liz.
I love that you ran in front of the camera for us. I do appreciate that. You are one of these voices of the market. You've watched it and participated in it for decades. What are you doing on a day like this? What is your team doing?
We're just continuing to dig into fundamentals. Our view is that we are in a period of shift. It has occurred for two reasons. One, the Fed statement that neutral is uncertain is farther away than we think. We're going to have to go longer. That just means the discount rate on all financial assets go up some. It hit the bond market first. Now it's hitting the equity market. The other issue for us is earnings. We think expectations are every bit as possible, as strong as they possibly can be. We think next year earnings growth is being a lot slower than the double-digit percentage the consensus views, and the market's looking at both those things and saying, we got to take a rest.
Okay. Well, you could call 682 points to the downside now for the Dow a rest. Bob, you will inevitably see this headline. Are we seeing the throes of the final steps of the bull market? Are we?
Yeah. I don't think so. I think
down 700 points right now, Bob.
Ratio,
down 706 and losing.
Yeah, and we'll probably go lower before the close comes. The peak PE was January. That does not mean the stock market peaks in January. We still have an economy with really good earnings. But the easy money's been made. It's more now what you own and don't own rather than is the stock market going up or down. That's a harder environment for most people to make money. We're obviously, even with these losses today, still been a pretty good year.
It has. Kevin, we do have a strong economy. The market diverges from the economy sometimes. Now we're down 715 points. Anybody who is just tuning in, we've been going commercial free for this final hour. There are 19 minutes to go before we hear the closing bell on a very rough day if you're long the market. If you're short these indices, you're in heaven at the moment because the S&P is now down 80 points, the NASDAQ down 268. Everybody likes to talk about Apple. I just want to point this out before I get to Kevin. Apple is now lower by about 3.5%. And so if you wanted to buy it yesterday, it's now 3.5% cheaper, Kevin.
I think what Bob said is exactly right. Key in on what he said. We're talking about a period of transition. We went through a 10-year period. 10-year period where you had interest rates at 0%. And suddenly people are waking up to the idea that, hey, there's a return to be had without taking on risk. That's a massive shift from where we were a year or so ago. The other thing that's shifting is the distribution of global growth. 2016 and 17, the global economy in synchrony was accelerating. This year, not so much. This news today that we're seeing some rockiness in our markets is not new news to the rest of the world. You look at Europe, you look at Latin America, you look at emerging markets, you look at China, which is in a bear market. Most of the rest of the world's equity markets have been under pressure and have been losing ground for most of the year.
So much for the reprieve of the VIX going to about 29% to the upside. Now it's up 36%. Who wants to take the bet that the Dow closes down more than 770 points? I don't know, Bob Dahl, does that even matter, especially considering we, as Charlie Gasparino points out, are nowhere near the February lows of 2018?
No, we're not. But, of course, earnings are a lot higher since then. Not that we can't revisit them. Look, the programs are taking over and doing the selling, and we're probably down from now to the close. And we'll see what tomorrow brings. Earnings are going to be key. We're about to embark on third-quarter earnings releases, and not only what are the numbers, but what do companies say about the outlook going forward? What do they say about cost pressures? What do they say about tariffs? What do they say about business in general? And that will give us some feel.
Some of them don't like them.
No, they don't like
Some of them feel that they're hurting the supply chain. You know, we have a fundamental change to the supply chain over the past several decades, and that involves the fact that you can say made in America. It really should say assembled in America because a lot of the parts have come in from overseas. But trade is certainly an element of this. But Peter Schiff is just emailing me right now, and we all know Peter Schiff of Euro Pacific. He's very negative often on stocks, but he had said to me, a day ago, he texted me and said, I feel like something weird is happening and that we could see a real market rout. And Charlie, we were looking this morning. The past 3 or 4 sessions, at certain points, we were down more than 200 points on the Dow and managed to climb out of the hole. Today, we're stuck in a deeper hole of 724 points on the Dow right now.
Yeah, I mean, Peter's my friend, but, you know, I could tell you that he's not the only perma-bear that's out there saying this is the end of the world today. I'm telling you, they're all chiming in. And again, I can't tell you where this is going. I can only tell you in the short run, and I'm going to say a lot of what Bob just said. In the short run, corporate earnings should be okay. In the long run, there are some headwinds. Trade is one of them, higher interest rates. And again, if the tax cuts don't materially affect GDP growth, if we don't get consistently 4% GDP growth, we're going to have our deficits gap out. That's going to mean higher interest rates, and that will be a drag on stocks. But these are longer term issues, I think. And again, a short term issue you should deal with. Do not listen to jerks in their mom's basement trading.
Okay,
and
but
90% of them on Twitter are.
You guys, Charlie's reading his Twitter and then telling us not to read them and not to listen.
No, I'm giving people advice.
Who tweeted this? Interest rates are rising. That's true. Stocks are falling. That's true. Budget and trade deficits are exploding. True. As autos, home builders, and financials are all flashing recession. If you think you've seen this movie before, you're half right. It's a sequel to 2008, but the ending might be much worse. Bob, that was Peter Schiff. Do you disagree with anything he said?
I don't think we have the leverage in the system or the financial excess today as we did in 2008. Is the world perfect? Absolutely not. Low interest rates cover up a lot of sins, and we had low interest rates for quite some time, and now they're beginning to go up, and somebody's going to be exposed.
Yeah, the tide's
Somebody
going
said the
out.
Fed will raise rates slowly but surely until something breaks, and maybe that's what will happen.
Well, you know, the one question I would have, and Bob would have a good feel for this, I think. You know, the structural issue with the market in 2008 was obviously the banks. It was the same structural issue in the early 1990s with S&Ls. The one structural issue we have now is, in a sense, the Fed's balance sheet. Is that something, if you unwind it, that could burst a bubble that could lead to something much worse than we're seeing now?
Well, the answer is, Bob's right. The tide goes out, and Warren Buffett's also said this. You see who's been swimming naked, and it ain't pretty.